We're looking at a stock with a lot of upside. It is severely undervalued. It is Celsius Holdings. We're going to take a look at this company in detail. It has been on a phenomenal run. We're going to take a look at their income statement, their top line revenue growth, as well as their bottom line net income. We're going to talk about the strong balance sheet that it holds, total cash versus total debt. We'll also take a look at their total return over the last few years. Absolutely phenomenal. And we will run through some of their financial metrics to see what holds for the future. We'll run it through the screener for insider buying and selling that we're noticing in the company. And we'll also take a look at that institutional ownership, whether or not they are buying or selling in the most recent quarters. And as always, we will run them through the valuation model. We'll get to the intrinsic value and acceptable buy price using our investor margin of safety. And we'll look to Wall Street to see what they are forecasting over the next 12 months. So let's take a look at Celsius's performance. Now, over the last year, they are up 53%. Now, bear in mind, they have had a pullback from that all-time high. Over the last 10 years, though, if this is a company you have been holding, you would be up a phenomenal 43,948%. Now, it doesn't currently offer a dividend, but at this point, when you are looking at returns year on year over the last 10 years, absolutely phenomenal. I don't think you would mind at all. In terms of their top line growth, well, remember, we do look for 3 to 7% year on year as a minimum. How about this? 53 million worth of sales in December 2018, 654 million in December 22. Absolutely phenomenal, more than 10 times growth, consistent increases year on year. And on top of that, they're expecting to double their top line from 2022 in December 2023. So lots of growth here. You want a fast-growing company, we have brought one to your doorstep. Now, bottom line, how have they performed? Well, we can see net income, in fact, was a net loss in December 2018 of 11 million. And in their latest annual report, we see a loss of 187 million. However, for December 2023, they are expecting some very, very strong growth at 156 million. So both the top line and bottom line over the last 6 years expected to be growing at a very strong rate. In terms of their balance sheet, now what we always look for a quick health check is total cash versus total debt. 8 million in 2018, 760 million in their latest quarterly report. So we can see they're holding a lot of cash compared to what they did just 5 years ago. Now look at this in terms of their total debt. Incredible. 8 million in 2018, 1.3 in their latest quarterly report. This is a very, very strong balance sheet, a lot of cash in comparison to that very minuscule total debt. Now, in terms of total return, so we are comparing it in the soft drinks and non-alcoholic beverages industry. We have quite a few well-known competitors. Now, in terms of performance, Celsius is one of the best performing. In fact, over the last year, it is the best, up 53.51%. If we extend that to the last 5 years, 3,755%. There is none of their competitors that comes anywhere near close as touching Celsius. Now, yes, you may be feeling like it has been on an incredible run, and it is important to note, just because of past performance, it doesn't dictate the future performance, but we will get to that valuation very soon. In terms of insider buying and selling, now we've run it through a screener. We've put at least 100,000 worth of insider buying or selling over a more recent period. We do know a lot of insider selling by the CEO. We have the 10% owner. We have the director, the EVP of North American sales. One thing I would highlight here is that essentially insider selling isn't a bearish signal. I would say insider buying is a bullish signal. Insiders buy. Why? Well, because they expect the price to increase over the long term or short term, depending on their strategy. They sell for many reasons, personal, financial. And the reason that I do point this out, we can see some of these more recent trades, the share price has gone up. We can see 18 or 17 to 18%, whereas there are some that did buy at a higher price or in fact sold at a higher price. So it's a little bit meaningless in terms of insider selling, but I do like to draw this out for the viewers just to see whether or not this is something they like. And as always, we should always do our own due diligence. In terms of institutional ownership, well, it sits at 60%, as we can see here. 500 million worth of sales by these institutions over the last 12 months. Same period, 774 million buying. So we can see institutions are buying more than they are selling. Q1 and Q2, more buying than selling. Q3, we see a lot of selling in comparison to the buying. And Q4, we see a huge amount of buys by these institutions in comparison to a very small sale. So again, we shouldn't copy, we should do our own due diligence, but the information is just here if you do find it useful in terms of copying what institutions are doing to bring that into your own investment thesis. Now, we're looking at some financial metrics here. They were free cash flow negative for quite some time, and we do personally ignore the earnings per share because it is susceptible to manipulation by management through accounting. Positive news, December, or in fact 2022, 39 cents of free cash flow per share was generated. 2023, they're expecting 75 cents, so they are becoming positive free cash flow per share consistently if we get that second year. So that is a very positive trend. Let's hope they do continue that and it does continue to increase. You may be looking at this and thinking, wow, double-digit increase to the top line, phenomenal. Well, typically we see the opposite. We see double-digit and the top line starting to shrink lower and lower. Well, this is the opposite. The last 2 years above 100% growth. In fact, when we look at 2023 expected 98%, they are growing their top line at a very, very rapid rate. In terms of sales then, well, we can see here it has grown a lot from 10 million in 2013, expected 1.15 billion in 2023. Now, it's not all positive. We do also draw out some of the negatives. Shares outstanding, we love it as investors when companies do share buybacks, returning excess cash to our pockets. We do know they've done share issuances, so your net position, if you had bought in 2013, you would have been diluted from 60.5 million to 227 in 2022. But the question is, would you really care given how much this share price has gone up significantly over that period? But again, it is something just to bear in mind. ROIC, now personally, I want to see 10% or more. The reason for this, it gives me faith that management are able to effectively allocate their capital. 2023 is looking like one of the first positives year other than 2020 at 17%. That is nice. Something just to keep an eye on. Yes, they are growing at a very rapid rate, but just because the top line increases, it doesn't necessarily mean the bottom line net income follows suit. So something just to keep an eye on, as we can see a lot of the years has been negative. In terms of their operating margin and free cash flow margin, again, it does show a different side of this company. Yes, there are a lot of positives, but also some things to be aware of. 2023 at 15% operating margin is very, very strong. If they can continue this, the consistency, whilst increasing their top line, this will be a very profitable and lucrative company to hold. Free cash flow margin, again, 2022 looking very strong, 2023 dropping slightly. So there are some things just to keep an eye on whether you are an investor or potential investor. And the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. This shows us the number of years it would take them to pay off all of their debt net of cash on hand. No surprise, we did run the numbers. It wouldn't even take them one day, given essentially how high that cash balance is in comparison to that minuscule total debt. So let's jump into the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we do run through every single one of these models, and we can say that Graham's valuation, given how extraordinary their top line has been increasing, doesn't really essentially become relevant for Celsius Holdings. In terms of their multiples, these other companies do not have the attributes and the metrics that we see from Celsius, given how high they are essentially increasing their top line. And therefore, we do jump into the dividend discount model, but they're not paying a dividend right now. So the intrinsic value will come and be derived from the DCF model. Now we look at their free cash flow year on year, we do see the growth rate. In fact, it is negative. We have gone, in fact, lower than analyst estimates where they are looking around 50 to 60%. We've gone much more conservative. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get our intrinsic value. Now, typically on the channel, the intrinsic value is the average of these four models, but for reasons stated, it only becomes the DCF price of $84. Now, in terms of the current trading price at $51, it did recently pull back. In fact, it dropped a fair few percentage points. Now, margin of safety, we typically start off with 10%, which we use if we believe it has a wide moat, strong financial metrics, good forward-looking data. So margin of safety at 15%, it is still a buy, and we can pretty much go all the way to around 40%, where it is around $1 shy. So for Celsius Holdings, we see a good 40% or thereabouts in terms of the margin of safety. based on these estimates. In terms of Wall Street, well, they see 42% upside, their price target of $73. They do see this as a very strong buy. Now, there are a lot of people on the channel who may say, this doesn't pay a yield, so it isn't one that I do like to hold. The only thing I would say is, do you mind if you are having a company that has some very, very strong annual returns, even though you don't essentially get to lock in that gain? It comes down to the individual investor's thesis and their goals. Personally, it does look to be a very strong company. It is one that I am monitoring, and I will be waiting to see how they perform in their earnings before making a decision. But it does look to be great, very strong margin of safety and nice upside. As always, if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list, do click on that pinned comment. Have a great day. See you on the next one. Don't forget to smash that like button if you enjoyed this episode, a little bit different from those yield companies we review. See you on the next one. Subscribe for more. Bye for now.